Our next guest says the four most important central banks effectively called a timeout on policy action over the last 2 weeks. He says they should use that strategy wisely. I want to bring in Mohamed El-Erian. He is the chief economic advisor at Allianz and president of Queen's College at Cambridge University. Mohamed, what do you mean by using that strategy wisely?
Good morning, Becky. You know, in sports, there are different types of timeouts. There's a timeout that's forced on you. There's a timeout that you take simply to decide the next play. But then there's a timeout which is more strategic. And I think what's critical is for the Fed, the ECB, and the Bank of England to take a much longer view as to where they are on the rate cycle, recognize that that they've done enough, and sit back and worry about other more strategic issues, then simply react to the latest set of data. We saw it again yesterday, Becky. We had even more Fed speak reacting to the latest move in the bond market, the result of which we saw yields go up 8 basis points, come down 8 basis points. They should, to quote Hamilton, talk less and smile more.
You mean you're talking about Neil Kashkari, who said that he thinks they should be very alert for the resurgence of inflation and that they may have to act more quickly now to make sure that they can get inflation back to the 2% desired level?
Yeah, and what most people think he was reacting to was the fall in yields and concern that financial conditions have loosened too much. We cannot have a Fed that is reacting to yesterday's data all the time. Their tools operate with a lag. They need to take a more strategic view, and they need to stop being volatility enhancers. You know, this unusual volatility in the bond market is not good for the economy. It can break something, and it undermines the standing of the U.S. in global financial markets.
Isn't flexibility a good thing? The idea of saying, we're going to wait and see. I think everybody kind of took the message from that they probably aren't going to act again anytime soon, but they want to reserve the right to say that if inflation pops up again, that they will act again, rather than letting the markets kind of take off to the races even more than they already have on this idea that they're done and that they're paused for the moment.
No, absolutely. I think they did the right thing. And you've heard me say for a while now they should stop. The problem they have is they seem unable not to respond to the latest market development, the latest data point in a world that's inherently fluid. They should just sit back, look, and take that strategic view you talked about, and not react to every single data point and every single move in bond yields.
But Jay Powell's not. You're basically saying you don't think any of the other Fed presidents should be allowed to speak?
No, I'm saying speak, but give us a strategic view of where monetary policy is going. Talk about the importance of bank supervision. Talk about the importance of non-bank financial institution and stability there. Simply do not overreact. Becky, think about it. You have a tool that acts with a lag. If you oversteer to every single data point, you will end up making everybody else sick in that car. You cannot oversteer, and that's what's been happening. And there's been studies now that show that the Fed has contributed to a lot more market volatility than we've seen before.
You know, it's even better analogy. It's not a car. You ever try to steer a boat? When you overcorrect, exactly. That says, whoa, you're going that way, and then, I mean, it's even more like that, isn't it, Mohamed? I mean, a car you can sort of get back, but the boat's already headed that way because of the water. But yeah, it's exactly what you're saying. There's a lag. They got to understand that there's a lag, but they don't seem to. That would cause them to have to look into the future, which they never try to do.
Well, former Fed officials and Fed chairs have, and that's been really important. I mean, that's the whole point of forward policy guidance. Forward is the key word there. It is not reacting to yesterday's data point. It is forward. And this is important because we know fiscal policy isn't going to offer stability. We know that the global economy isn't going to offer stability. So you need an anchor. And it's particularly important at a time when growth is slowing. So policy should be volatility reducer, not volatility enhancing.
We're going to have Senator Rick Scott on. He wants to hold Jay Powell accountable for not reducing the balance sheet of the Fed. And I immediately thought, if you had to name defendants in a lawsuit against people on the Fed for doing that, how far back would you have to go? It's not just Jay Powell, is it? We got to go who do we got to go back to? Ben Bernanke, and include Yellen.
I mean, you go back a while, because unfortunately, the Fed turned what was supposed to be simply a bridging operation into something much more long-term. And every time they tried to exit, you remember 2013, May, the taper tantrum, they didn't have the courage to absorb the immediate market reaction. It's like, I said it at the time, it's like taking candy away from a kid. The kid will yell, but the answer is not give them more candy. And unfortunately, we became over-reliant on central bank balance sheets. And they did a lot of damage because they allowed excessive risk-taking. You were talking about WeWorks earlier. Just look at what's been happening in terms of excessive risk-taking all around the financial markets. And that was a combination of reliable liquidity from a non-commercial buyer, and that's a really important characteristic. And secondly, interest rates that remain too low for too long.
Mohamed, ultimately, you think that the Fed won't have to do anything, that rates will come down from where they are right now, or they'll have to be brought down because you think the economy's headed into a recession and the Fed will have to react?
So, Becky, I think the Fed's influence on rates now is mostly over. In 2022, it was all about them playing catch up to being behind on inflation. In 2023, it was all about them communicating that rates will be higher for longer. 2024 is going to be a tug of war between lower growth on the one hand, pushing yields down, and the fact that you're going to see an enormous increase in bond auctions, an enormous increase in the refinancing need of the government. And I hope that that tug of war stays balanced. All those who are wishing for lower rates quickly, I tell them, be careful what you're wishing for. Because if we get them, it's because the economy has gone down too quickly. And if that happens, then interest rate risk turns into credit risk, and that's much harder to navigate for markets. So let's hope that that tug of war, with the Fed out of the story now, that tug of war between somewhat lower growth and higher bond issuance is a well-equilibrated one that doesn't create problems for the real economy.